made sense to me, and I'd rather go with a theory that made sense because I can fully explain it than something that I couldn't really explain. Does that make sense? Um, so, all right. So what I got from this is because it's a 15
Yeah.
delta
So
and
explain
a
it. Let's
15
hear it.
delta and they're matched, I've learned that that would usually lead to believe that we're going delta neutral on this one. And because it's a trade at 350 at the end of the day, and that there's no VIX filter on here, and because it's delta neutral, I realize that since it says usually with delta neutral trades, you're not focusing on the price change, you're focused on the volatility change. And I figured that since it's at 350, the graph, when you look at the SPS
Yep.
XPX graph, there's not a lot of change down there, but there is enough change at the end of the day for us to still make money off of the volatility. But we're not like going to be going all crazy with it. It's kind of going to be settling down, but there's still enough movement to make money. So I figured that that's kind of was the purpose of this trade.
Okay. That's pretty spot on. Now, kind of looking at this trade, was there anything in
Um,
particular that concerned you with the performance of this
When
trade,
I was really thinking about the
or
theory of
that you
it,
want
it
to make a
wasn't
note
the
of
it
in
was
regards to
I
that?
would say that it was a pretty good performing trade when it depends on like what we're trying to do. If like it seemed like when I was looking at this portfolio, you're just looking at a base hit portfolio. So like it was a pretty good trade because it has a very low drawdown. And it does make us money and it does make us premium. It does concern me a little bit about it performed really well in 2022 and 2023. It's performing and it has a little bit more of a drawdown in 2024. That concerns me a little bit. But let me see. Oh, and the winning percentage. I didn't see that. The winning percentage only being 66%. That concerns me a little bit as well. I'd like to see that closer to like 70 or 80, especially with a base hit trade. Because you're not making much off of it and you're like
And
look at the
why is
loser,
that?
like the max winner versus the max loser, so like I want to win more to balance out my losses as well. So huh.
Okay.
Yeah.
Yeah. So let's kind of unpack all the steps in this. And then
All right.
also, when we're analyzing a back test, we'll kind of go line by line here. So if you look kind of like at this first thing, we have our
Yep.
dates between May 16th of 2022 and then obviously present day. The reason this is the case is
Mm.
because May 16th is when SPX daily began to occur on a 5 day week basis. So before that, the expirations were only Monday, Wednesday, and Friday. With this trade being a 2 day to expiration that's placed on Monday, that would be a Wednesday expiration and then a basically um, Friday expiration as well. So, in regards to that,
All right.
uh, this could have traded a long time ago, but we're more concerned with the recency in regards to the calendars because uh, with that, the SPX price is kind of a little significantly different in the past, and it may have not been as liquid before the SPX dailies. So I would say we're going to lean towards the calendars on this SPX dailies expiration. My thing with that also is since it's profitable in all 3 years, that's good. So we can't expect, I would say, this trade is
Yeah,
not
yeah.
necessarily an outlier, but that 2022 was an outlier of understated volatility. And the other thing to think about this is when volatility is higher, even if it's still 10% overstated, there's more dollars in that position each and every day. So we're going to drag more from just getting in and out in that period of time. Basically, what we're trying to do here is since it opens at
Yeah.
350 and then we close it in the morning on basically
I
Wednesday,
saw that too.
this
Yeah.
is mainly trying to capture the overnight premium, which is rich. And I know this technically isn't zero DTE, but the thing I want people to think about when we're going through this is the benefit of this in a zero DT portfolio is that this position does come off on Wednesday, so we can reuse that buying power again on Wednesday. So we basically get 2 trades in a week for the same buying power. The other
Yeah.
thing with this trade is, since it's risk defined and you see there's no stop loss here, is that during our credit trades, if the market kind of bang bangs up and down,
Yeah.
we get stopped out, and we get stopped out on the put side and the call side in a really up and down thing. Whereas all the noise over 48 hours for this type of trade is basically irrelevant. It just matters if it crosses that perfect, it's called a profit tent. So if you were to think of like our risk to reward, it kind of looks like, I'll draw this out. I think this is how a double calendar works, but so basically we kind of have a, like, you could see
All right.
this is like the perfect 40% target, and then our profit kind of like tails off in regards to there. You can go back to the back test. So visually, without that stop, if we just cross through, it's called a tent, that profit tent, where like a day into the trade it's decayed, and then we like pin the exact same strike from entrance. That
All
is
right.
basically like perfect um, for this type of trade. So it's a lot different mindset of a
Oh
traditional
yeah.
zero DT trade, but you could kind of see the benefit in regards to yeah, the diversification that this is going to provide to us. The other thing I want to show you too is if you click trade log,
Yeah.
so you can see here that it says DB,
All right.
DB, DB. You see that premium? So that means it's a debit trade. So this is why we can basically not use a stop loss, because with that debit, our risk is somewhat defined
Yeah.
for what that's going to be. See the lines that go through that one test up there too. So what that those lines mean is that there is a wide bid-ask spread. So if you scroll all the way to the top, you can see here that it says we're excluding wide bid-ask in our back test. So that kind of shows what that is. The other thing too, when we do this back test, is let's continue to scroll. So like you see this first trade, it says profit target. You can see that our open price was
Yeah.
55.93. And then when we hit our profit take, it was 56.11. So that kind of shows like over the course of basically 2 days, the SPX only moved 20 points, which yielded a profit. And then you can see the one below that on the Monday, we entered at
All right.
53.35 and it went up close to 100 points, but we basically broke even on that. So this is just a better way to kind of understand what that looks like. And then going back to your
All right.
percent win rate, if you scroll up here, we're not really concerned with
All
that
right.
win rate because there's something that's basically referred to as expected value. And expected value would be our average win times the
Yeah.
percentage minus our, average loss times the percent we lose. So you can see our average win is $230 and our average loser is 161.
Wow. All right.
Our break even win
No, that
rate is
makes sense.
actually
Yeah.
like 40% with that. Does that kind of make sense? Uh, Yeah. And then the other things under miscellaneous.
Yep.
Uh, so we have 20 cents entry slippage and 20 cents exit slippage. Again, if we look at kind of those average premiums, we're around $1,500. So, we'll call roughly 2% of that in and out, since it's not going to be a stop loss, really. It's just exiting through the market. 20 cents is pretty accurate.
Just take
Then we
it.
also have cap profits. And basically, what that means is if we were to hit our profit take, instead of just taking, yeah, and like if the market were to gap up 50 cents instantaneously, that's what would happen in real life. But what capping profits does is just whatever our profit take, it'll just subtract 20 cents from it when it hits an options omega. So on a day-to-day basis, that may not be the most accurate reflection because obviously the market jumps in price a little bit.
So just to
However,
think
in the
about that
back
in theory
test,
for
that's
me,
just our assumption that we
like
know will
when you
work
set
over a
that
long
profit
period of
take,
time.
like, hey, we
So
hit that
this is
40% profit take, we're gonna take our profit and run before this dips down, right?
Yeah. So basically, we back tested, let's say 10%, 20%, 30%, and the win
All right.
rate versus the average loss and average loser, this looked most attractive, basically. So that's kind of why we took it. And you can also see here, again, this is kind of contextualized in the back test, so there's more numbers. So like scroll down and then skip to like the second page. So scroll all the way down and then click the right arrow. So we can see here that, our exited. So if you look at this right-hand column, it says reason for close, exited specific time, exited. You can just scroll down. You see all those. So basically, this is almost always going to 10 a.m. on Wednesday. However, we just had the 40% profit take because if it was really good, that's kind of like the attractiveness of where we would take it. So the 40% profit take, if we hit it, it's probably going to be Wednesday morning. So this is more of a hold till expiration trade. But basically, if we get some really nice price action that it gets between that 10, we'll basically take it. The main thing we want is it's just going to decay. And then if you go back up, I know you identified this trade as a delta neutral trade. So the other thing to understand with this is
the decay.
This is what's called a short
I've heard
theta
that
trade,
a lot when I was looking this stuff up.
Remember when we were looking at that chart thing, basically? Yeah. So the way to think about this is the shorter the duration option, the faster the option decays. So a 2-day option is going to decay faster than a 4-day option. Does that make sense? So and then each pending hour, as that short option gets closer and closer to 0 DT and it gets closer and closer to 1 hour to expiration, it exponentially speeds up its decay. So if this trade, like you can see on that first Monday, January 29th, 2024, this trade, basically the price only moved, 30 points over 3 days. So basically from no movement, since we were short volatility, this thing expired and it decayed $187. So because the market didn't do anything, we basically
that's why the delta neutral is
from the market
a good position, because if the market doesn't do anything, you're good and you're making money off of it.
Yeah, so the way to think of this trade, and it's like for fun and games, you can creatively name it. So if you want to click the little notepad, and then we can call this Monday 2-4 DC, and then put like quotations and say no news is good. It
adds like context for me a little bit.
Yeah, and that's no news is good news.
Yeah.
And that's essentially what we're trying to do. This is like the boring trade. You know what I'm saying? It's like we don't really harbor a lot of risk. It doesn't really matter if it gaps up violently lower or higher. We just kind of want that. And then the thing I want you to understand is putting a little more context behind these trades. So if you want to click that download thing right here.
I think so.
Right here.
Is this the Excel? Export to CDS?
You may not on this computer. Yeah, click it.
I think I have like the basic one that will allow me to at least view it. Oh, here it goes. It's trying to.
Oh, it looks like it works. Okay, so now the next thing I want you to do is go to scroll right a little bit. Okay, so on W, click the top W. And then go to data up at the top here.
Do this to edit for free. Well, I think it'll let me to edit for free.
Okay, well, basically, if you kind of don't worry. If you click in X and go equal, click the equals. If you go to, just click there and then go equal. See if that populates anything. Equal MIN. Okay, now double click min. And now start with the second row and then pull it all the way down to the bottom. And now hold it and pull it all the way down. Oops. Try that again. Equals min. Just click back on the formula. Yeah, there you go. Now scroll all. So actually, you could just type it in. So it just goes equal min all equal min and then go parentheses or double hash dots. Go W2
Yep.
and then the key next to the L. And then W. Okay, now click enter.
Do you want me to just drag it down?
But basically, yeah, just drag it down to be the same thing. We don't, I think you put in a parentheses instead of the other one, or yeah, drag it down. Yeah, just drag it all the way down to the bottom where there's no more letters. Okay, now click enter. Okay, so that's our biggest loss is minus 50.24. So now scroll down and look for a 5. See if we, okay, there it is. Okay, that date. What's the date?
2/5/2/15/23.
215. Okay, now go back to the back test.
Yeah.
So I want to see what caused this. 2/15/2023 was the
Yep.
date. So now skip over. So that's February
There's
15th. So you can use the thing at the
2022.
bottom right to get over to that.
It looks like
Okay, there it is, February 13th. Okay, so let's see what happened here. So this is a weird trade, and this is why double calendars are weird. So the price was 4135, and then the price ended at
makes sense.
4111. So it didn't move, yet we got
No, yeah.
destroyed on this trade.
Yeah.
So no, it doesn't make sense because we're short data. You know what I'm saying? So what I think happened
Yeah, because the whole point, yeah, you're right. It doesn't make sense
let me
because the
look
whole
it
point
up.
of the trade is for it to not move.
2023. Okay, so there was a Fed meeting. Yeah, so this wasn't during a Fed
Yeah.
meeting, and this is double calendars don't really make sense on a shorter duration, but basically there was probably some event that smashed volatility that was tied to the Friday expiration. So like maybe they said something on Wednesday morning, like there's a data announcement, and then it just completely smashed the volatility that was on Friday. So instead of the front decaying faster than the back, it didn't happen. So the volatility like stayed elevated on Friday and then it didn't on Wednesday. So there was probably a news event, but this is what I like to say is like we're understanding this back
So if the
test in a little more
volatility doesn't
detail,
perform
and that kind
as
of
it
gives you
normally
confidence. And then
performs,
the
that's
next
when
thing
we
you do
get
is you go
screwed on
back to
this
that
trade.
Excel
But when it's
sheet.
performing, how it just normally performs if it doesn't move. Yeah, exactly.
Yeah, if the market didn't move, we should have made money, but there's probably some event here. Now, like if it went down 400 points, then yeah, I would anticipate losing. Go back to the spreadsheet. And then go enter max so we can see the best winning trade and what happened.
Max.
You'll have to double click it and then do the same thing.
Freaking, there we go. 47, and so.
So what was 47?
So 42.
Actually, scroll up. Okay, perfect. So if you look at 42, the market moved 12 points. So that makes more sense because it says movement. You see that? And then like another gap doesn't
I see what you're saying.
matter, but that kind of makes more sense. So the market didn't move, we made money. You know what I'm saying?
Yeah.
So this, I mean, we know this is going to work because it's back testing, but it's a new context to why it's working. So if we go back to the movement, now let's try and find, scroll up and then go enter max and then use the movement column, which is V.
Yeah, it's starting to make sense to me too, because when you look at the movement, when it moves a lot, I mean, when it has a lot, that's where the profit is.
Yeah, we're screwed.
Yeah.
Because volatility was not understated, and we're technically short volatility. So when we're short volatility, we're short vega, but we're mostly short theta. And on the other side of theta is gamma, which is the change in directional exposure per dollar of SPX change. So they're like two and thin. Okay, so the largest movement was 74.
There it is.
So
We
if
actually made a
we
pretty
look at
good
something like that,
profit.
see if you can find 74. There it is. Okay, so we made money on this. That's kind of
Yeah.
interesting, but this just gives a little more context. That smashed the volatility because it went up. You know what I'm saying? So this is just a way to understand it, and I like to analyze the data within the spreadsheet a little more. And then we'll eventually use this once we have the actual data of a real trade to basically
Mm-hmm.
compare actual trading that came out of our automation software to these results. So we'll come back to this data, but we'll just check it on a yearly basis. I mean, on a
All right.
weekly,
Yeah,
on a
this makes sense
bi-weekly
though, because
basis.
like when it
But if you
doesn't
want to
move
go
a
back to
lot, it's
options
still
on that,
making
you'll be
good money,
familiar
and
with the
that's the
next
whole
trade.
point of the trade. Like when it's like barely moving, it's making really good money too.
Yeah. And also that movement reflects kind of the movement from open to close. So it could have been a little different that we
Like
like
these
hit a good
these
profit
three make
throughout.
sense,
But
right? This
generally, when the
one
market
it
goes
didn't
up, it'll
move
bring down
much.
the
It had
volatility,
made
which
us
is helpful
47,
for
and then when it moved a lot, it didn't make us that much. That's when those when it start making a little more sense. But all right, for time's sake.
yeah. And then another thing too, so go to this backtest again and go create new backtest.
Oh, all right.
Okay,
Yep.
now
Use
scroll
VIX.
down
Where do you
and
want me to
use the
set it
VIX.
at?
So use VIX, and then no, actually exit out of that.
Oh, I see what you're saying. This one.
Now
Yeah.
go up to the top and use VIX. Go up to the top, use VIX too. Now go max VIX of 15. So remember, right now our win rate is 66%, and our capture, I believe, is like 6%. So now click run. So this is basically testing our theory that just the higher volatility, because we have less drag getting in and out, it helps us. So this is 7%. So our
All right.
theory was not right that the high volatility is what helped us. So I actually like this. Basically, irregardless of volatility environment, irregardless of if the VIX goes up or down, and irregardless of year, whether the volatility is 30 or 12, it works. And it's not really changed. So this is a big vote of confidence that this is what we refer to as an evergreen trade. Um, Basically trees that are evergreen um, don't lose their leaves. So basically, in winter, when stuff's bad and scary,
Dude, I love
this
that. I'm
trade
gonna
will
go
still
back
work,
and
whether
put
that be low
evergreen
or
on
high
this one as
volatility
well
or something in between.
because I like the
Yeah.
yeah. This is the
No
base
news is
hit
good
trade.
news, evergreen. But this is kind of what we want is these evergreen trades. Yeah, like this is
I
boring.
know that's
You're making
boring.
$100 a week, basically. And basically what this will look like is the first week of the month you'll win 250, second week of the month you'll lose 160,
See, that's what I was
third week
saying.
of the
That's what I love
month
about this
you'll
trade
win
because
200,
if
fourth
you
week
look
of
at
the month
these,
you'll
we're
break even.
capturing
And
all
that's
of our
basically what
losses and then some. You know what I mean? Like
yeah.
this is 400, but we won 700, so we got roughly a $200 profit off of this one. So
Yeah. And if you go back to the summary,
yeah,
click summary,
yeah,
you can kind of see like what this trade does. So it
yeah.
basically
It
just like
makes
ping,
perfect
ping,
sense.
ping,
I
ping,
love it.
and it just kind of
That's what
slowly
I
goes up.
just to like take a shot at this whole portfolio.
So it's pretty good.
We're gonna dive in it step by step, but like, I really think this portfolio was designed just to be like a solid, balanced trading portfolio because a lot of them are like pretty. Like the next one is like really far out of.
Yeah.
You're like you have a 5% chance of being in the money, so it's like you're kind of just playing a safe bet, but you're also still making money off of that safe bet. So.
And the other thing too, if you click on the trade log, is this on average uses about 2 grand of buying power. So we're only using 4% of our account value,
Yeah.
and we're basically doubling our money because it averages almost 8% return. So this is a really capital efficient
Yeah,
trade,
100%. This
which
is
is
very attractive
attractive
because we just
to
made in
an
two
account
years, we
like yours
made,
that is only 50 Gs.
10 grand off of this. And exactly.
Only on 2 grand a yeah, and that option buying power is only used until Wednesday. So we could basically use a trade that goes from Wednesday to
Mm.
Monday, and we could, use that buying power twice.
That's
So
what I was going to
that
ask
five,
you.
that 2 grand of
So on
buying
this
power
one,
could potentially
you're
make us
talking
like
about
thirty
using
five
this on
hundred
Monday.
bucks a year or
Basically, would
something.
we just copy and paste this trade and do new back tests and just put it in for every Wednesday as well? So it just is doing the same thing.
Uh, I think there may be a Wednesday one there, but this is good. We're gonna run it. And the thing kind of here too is we also have required to prices for profit take. So basically what that means is for 2 consecutive minutes, it needs to hit our profit take. So it'll ensure us that if the market just were to make like one quick blip, we could potentially not get filled. But like if this get filled, we're definitely going to get filled. So like we have our first trade, we did our research, we have an understanding of this, and basically now we're going to stick with this for 6 months and see how it goes. And then we'll start tracking it every other week, and we'll be like, hey, this is in line with what we're expecting. One thing I will say on this is you can see that like on that first Monday trade, it took a 55.40 and a 56.40. Those will vary slightly because what will happen is option omega just enters the trade right at the top of the minute. Whereas if the computer goes to enter the trade at the top of the minute, let's say within 2 seconds, the SPX went up 2 points or something, we could now take the 55.45 or something like that, and we may collect $15. We may pay $15 in premium instead of $18 in premium. So in the short term, we'll get a higher loan or just average out over time. The main thing we're concerned with is like
Yeah.
if this trade won in the back test, it won in real life. We're not really concerned with does it have the same strikes and does it have the same debit amount, basically. So that's more of a nuance once we go into it. We don't necessarily expect to collect the same premium on these in real time, but we also we do expect it to win
Awesome.
1 week. That's just kind of how it's going to work.
So
But
let me
let's go to your
try
other trade so we can get this second
the,
one done.
let me see this one. Yeah, so this one, I feel like this one
Do the
pretty
5 delta,
self-explanatory on
5 delta
this
stuff.
one. On just like it's a very low delta, so we're saying it's a very low percent chance that it's going to be in the money. So basically, I learned that that is meaning that we're thinking it's not going to strike down really hard. Yeah,
Yeah, we need a massive crash. Like if you scroll down and you look at 2024, this
yeah,
thing was clearly doing well until people were
exactly.
calling it Vixzilla, which was, the massive Japanese thing. Oh, dude, I've actually never thought of it. It's kind of funny now that
Oh,
it's Japanese and it's called Vixzilla because the
Bixville,
Godzilla has stopped
yeah,
over.
or
So yeah,
whatever.
let's
Yeah,
let's name this one. We'll go Vixzilla. Yeah. Or let's call it pennies in front of Vixzilla Steamroller. Like, let's call it that. But
yeah,
basically, some shit's got to go really wrong for us to lose on this. And the main thing with this is that we just don't get too big and too greedy because you can see in 2024 before Vixzilla, or if you go to trade log,
yeah.
so this thing,
It
scroll down,
does.
routinely wins, 20 in a row.
Oh my gosh. Yeah, it hasn't
Like
lost.
we
I
can go
mean,
six
literally,
months
look
and
at
this
this.
thing won't lose.
What's it
But
start at in
yeah,
August, and it only lost. The first time it lost was February.
yeah. So this is a pretty set it and forget it trade. And, for people online, if they don't want to
Yeah,
use a bot, this obviously is not very labor intensive to put on. The things we need to
yeah,
note on this is you can see max loser 894. So basically the kind of funny thing about this trade is we're selling an option, so we believe volatility is understated, but then we're buying an option that's relatively expensive. So if you look at Friday, February
Yeah.
2, we sold a $2.35 option and we bought a $1.50 option. So by this being a tight spread,
Mhm.
we've essentially baked in
Yeah.
our hedge or black swan type protection, basically. Uh, so that's just kind of a thing to note with it, but
No, I
I'd
think
like
you
to
kind
hear
of hit the nail
more
on the head
what
on
you
that.
liked
Just
about this
saying, like,
trade
it's a very
and
protective trade
like
because
what are your thoughts?
you're really you're playing with the 7 DTE as well, so you're playing with the time decay. So when it gets farther closer to the 7 DTE, like we're gonna be able to capitalize off of that time decay as well. And you, um,
Yeah.
I
And time
I
decay
don't
is
know that one to
otherwise
be
known as
honest with
what?
you. But yeah,
The
all right.
Greek
So, yeah, so I looked into
theta.
that and I
It's
really just looked
theta.
at this trade as
Yeah.
just like a really solid trade. Like you said, I kind of figured, I didn't look at the trade log, but I figured it was winning a lot because it was just like you really are just kind of that you're basically saying the market is not going to just drop like crazy, you know? And so by playing out of the money so far, I feel like it was just a safe trade because you're not like making a too big of a prediction that it's going to strike up or it's going to strike down, and you're kind of protecting yourself on that. So that's where I really was the big thought process behind this trade. Yeah,
Yep. And it's
that's
a
true.
very good diversifier because it's a 7-day duration. And then also you can see here's, I mean, this is on $1 million account. So if you want to click
Yeah, I
new
wanted
back
to
test
scale it and see what it would look like on
and then change this to a
50,000.
$50,000 account, like your account,
Where's it?
let's do a
Oh,
one lot.
yeah,
Change
two.
it to one lot. Scroll down. See how it says max contracts per trade, change it to one, and then go to margin allocation per trade and change it to 100. That's just so we know it'll always trade one and then run it. So this is just habits. We don't want to run $1 million account on it
Yeah,
because we could look at this and be like, oh, our worst drawdown we could take is only 1/3%. So to realistically feel what this feels like, we're going to change it to
exactly.
a 50 grand account
And
so
to
we
be
know
able to see
personally on
like
your
what the
account
profit
what's the
take
worst
really is
case
going to look like
drawdown that you could
too,
potentially
and
take.
all that.
So that and yep.
Um,
And then do you see
what
that
was that?
MAR ratio? Do you
I
remember what
can't
that
remember what
means?
that means, but I know we want to be above one or above, right?
Yeah.
Yep,
So the easy way to remember MAR is if you look at that
that makes
tagger
sense.
and you divide it by the max drawdown, which is right next
Save
to
it.
it. That's how you get it. So if you save this back test. Yep. And then you can just yep, just replace it. So just now click save. And then the other thing
All
too
right.
is when you post this video, click the link and post those in the description so other people can see. Now click on summary. So let's cover this MAR ratio more. So if we scroll down, now go to 2018 and hover, or let's go to 2021. Hover over the green. So we had a 4.69% return, and then hover over the red. Our max drawdown was
So on just
8.99%.
to
So
make
what
sure my
MAR
numbers are
ratio
clarified,
would a
right? On
2021
the
been?
4.69, that is the CAGR, right? Or return.
Technically, that's just the return because CAGR is compounded annual growth rate. This
All
would
right,
just be
so
the
you just
return for
divide
that
these
year. But
two. So that would
yes,
almost
you're
be,
theoretically you
a
are
four
correct.
point. That would almost be close to a one MAR as well because they're pretty. No, we would actually be.
Is it? So you had a
Oh, my bad.
4.6%
Yeah,
return
so
and your
that would
max
be like a
loss
four
was
MAR,
what?
wouldn't it? Yeah, yeah, that is.
4.69. Yeah. So that's a banger of a year. You know what I'm saying? And this is why this is a dangerous trade because people will get
Yes.
greedy because you could win 20 in a row and you'd be like, I want to sell a 10 lot, and that would be like your whole account. So the main thing with this is you need to understand that like you're gonna get hit and you have no
Yeah.
idea. Like, we didn't know that the Japanese central bank was going to
Yeah.
raise their interest rates randomly after we won 20 in a row,
That's
and
where on
when
the
they did, it
downtick
plummets.
right here. Yeah, that makes sense.
So so this is just kind of a thing you yeah, it was a big drop. But again, that long leg that we bought helped us out a lot. And this is kind of another example where people get greedy. So if you click on new backtest and then click the X underneath the buy put, and then scroll down and click ignore margin requirements. And then add a 0 to the
That's where people
starting
get greedy.
funds. Okay, but you can see and then click run. Okay, so you can yeah, so you can see that we made 15 grand on this trade. But what happened was we bought the protection. So we're basically spending we're selling volatility premium, which we think is rich, which is the red
Yeah.
put, and then we're buying the protection. So we're actually buying a lot of what we think is expensive, which is kind of contradictory. And
The
we
money
obviously
that we
incurred a lot
needed
of
to
drag
buy. I
on
mean,
that
we had to buy.
because we lost, you know, 15,000. Yeah, so we only made 15 grand. And then if you were to take away that long option that basically protects us if something were to go wrong, you'll see that we made a lot more money,
Yeah,
but we had a lot more
that
volatility.
makes
So you
sense
see here now we made 61 grand, but our MAR went down.
because this bad boy
So
right
this
here.
is an example where it pays more,
No, yeah,
yeah, to buy protection. You know what I'm saying? So and this is the whole concept is you can see here the capture rate's lower, we make less money, but by not having negative compounding, our risk adjusted return is actually better. And this is the concept that I find kind of nuts about this. And the way I would describe it is it's like, imagine
yeah.
you were selling this, but it was a car insurance policy. So in this instance, when we sell the
What
5
max
delta put
protection?
and we buy the 150 below it, like you are selling the car insurance. Yeah, you are selling the car insurance as the car insurance company with the 5 delta put, but
Oh,
you're
so
also your customer is also making a claim on the car insurance $50 lower, and you as the car insurance company made money, and the person that bought the car insurance made money also. So this is kind of a crazy thought where
yeah,
it's like you actually ended up better off and both parties won. The party selling the insurance won and the counterparty buying the insurance won, which is kind of a wild concept. It's not supposed to be how you do it, but this is where like people will say, "Oh my god, there's no free lunch, options are efficient." This is an example that options are efficient, but somehow both of us can make money. And the reason this happened is because the person buying the car insurance is not trying to make money. They're just trying to offset that massive loss that they'd have if they get in a car accident. And the person selling the car insurance is trying to make money on selling the car insurance. But if one car insurance person gets in a car accident out of every 70, they still make money. So kind of a wild concept, but this is how everyone makes money. And the market maker that sold this to you and connected the buyer to the seller of the car insurance, that's basically the entry slippage and the exit slippage, also made money. So
yeah.
everyone can make money in this. This is like the best welfare system on earth. The Wall Street market makers made money, the car insurance
I
company, you
forgot.
made
That's why
money,
I think I
and
was
then
trying to
some
think
hedger and then a
almost
mutual
too
fund also
detailed
made
on this
money.
trade because I thought
Because
I forgot that when even when we just run back to just running premium captures, and we're doing premium trades, like when you sell a put and you buy a put, that buying a put, it's capping your buying power, but it's also protecting you. And I forgot about that one. Yeah,
also
yeah, the
protection.
win rate's freaking fat.
Yeah, and the other thing you notice here too is look at the win rate. That
The
94.6%
chance the
win rate
option is winning.
corresponds to
Yeah.
what? The chance of this option is,
On this one, we're winning out of the.
yeah,
I mean,
what's
we're
winning
winning
in
out of the
this?
money.
In the money or out of the money?
Yeah,
Correct.
yeah, that makes
So
sense.
see, you
Awesome.
get it. This is the recipe, and it's pretty straightforward.